Hello and welcome to this session in which we will discuss outbound transaction. What is an outbound transaction? An outbound transaction is when an individual from the US of A invest in other countries, invest in Europe, invest in South America, invest in Asia. This action is known as outbound transaction. Now, the earnings from these transactions outside the US, they're known as foreign source income. In other words, this income is coming from foreign sources. Now, we already looked at sourcing income. You want to make sure you are familiar with what is a foreign source income versus US source income. The term US person, when we say US person, it doesn't mean an individual. It could mean an individual, a US citizen. It could also mean a resident alien, which is not a US citizen but resides in the US with a green card holder, a partnership based in the US, a corporation established in the US, or a trust or an estate. So a person, it doesn't have to be like one individual. Don't think about one individual. In this session, we will discuss how is that individual is taxed. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Now, the first thing you think about is why do we invest in other country? Well, obviously, the reason is to make a profit. We think it's a good opportunity. That's always the case. That's what we assume. Also, what could be the case is we are trying to participate in some sort of a tax deferral. What is a tax deferral? Delay paying taxes. So what is the general rule? The general rule is this. U.S. person, individual, corporation, partnership, U.S. individual, have the ability to postpone paying taxes on income they generate from foreign sources until that income is brought back in the U.S. And this process is called repatriation. For example, when an earning from an international investments are sent back to the U.S. as dividend, this triggers the requirement to pay U.S. taxes on these earnings. So there's this deferral mechanism. However, you have to understand that the deferral mechanism don't apply only to business activities in foreign country. So when do we have this deferral? When we have business activities. Business activities means we are actively conducting business in that foreign country. Versus what? Versus passive investment income. If you have a passive investment income coming from another country, if you're a US and investing in overseas in another country, and that investment is a passive investment income, then you cannot enjoy this tax deferral. What is tax deferral? Delaying paying taxes until later. You can't do that. Later means when you bring it back. When you have a passive income, guess what? You have rules in the US that's going to tax you immediately. We have these called anti-deferral rules. Anti means the opposite. You cannot defer your income. So the US have specific regulation limiting the deferral of US taxes on foreign tax income that do what? That earn that income, and it's a passive income, and they cannot defer it indefinitely to avoid paying taxes. Because the US government knows that if you are investing, the money is easily transportable. For example, rather than opening an account with Schwab or E-Trade or a financial institution in the US and be subject to US taxation, how about I open an account in a financial institution in a tax haven country and I keep my money there and let it earn money and it's tax free. I don't have to pay taxes until I bring it back. Well, that's passive income. The US government, so no, this is easy. Anyone will do that if we allow this. So these regulations are called anti-deferral, means you cannot defer your income. So there are two rules we need to be familiar with. The first one is the passive foreign investment company. So your investment could fall under this passive foreign investment company, or it could be under the controlled foreign corporation rules, which is subpart F. In this session, we will discuss when your investment falls under the passive foreign investment company, and if that's the case, what do you need to do? Well, let's first define what is a passive foreign investment company. Hopefully we all know what a passive income is. So this sets of rules, the passive foreign investment applies to what? Primarily to passive income, or to companies that hold assets that produce passive income. What is passive income? Interest, dividend, capital gains. Basically, you put your money somewhere and the money is working for you. What are assets? What are assets that produce passive income? Stocks, bonds. Those are the assets. So the passive foreign investment income is designed to discourage U.S. persons from deferring U.S. tax by investing in foreign entities that do not conduct substantial active business operation. Now, if you conduct substantial business operation, you're conducting actual business, that's fine. You don't pay the taxes until you bring it back. But if you park that money over there to generate passive income, well, that's a different story. So if a foreign corporation meets certain criteria that classify it as a passive foreign investment company, U.S. investor in that corporation will be subject to the current taxation on certain type of incomes and gains, even if they don't receive the distribution from this passive foreign investment company. So you made an investment. Well, the U.S. is going to say, is this a passive foreign investment company? How do we know whether it's a passive foreign investment company? There are criteria. As long as it meets one of those two criteria, it is a PFIC. First is the income test. This test determines whether the foreign corporation is a PFIC if 75% or more of its gross income in a tax year is a passive income. What does passive income include? It means the majority of their income is dividend, interest, rent, royalties. Those are passive income. If 75% of their income is a passive income, well, guess what? Then you are what? You are investing. This is a passive investment. Therefore, you are subject to taxation on this income in the year you earn. It doesn't matter whether it gets distributed or not. So passive income do not require regular active business operation. The money is working for you. Passively, your money is working for you. Asset test. The other test is asset test. A foreign corporation is classified as passive foreign investment company if at least 50% of its assets are investments that produce or help to produce passive income. What are the assets that produce passive income? Stocks, bonds, real estate. Those, they generate dividend, interest, and rental income, passive income. If at least 50% of their assets, guess what? You're under the PFIC. Now, how the PFIC are taxed? So you as shareholders, whether direct or indirect shareholder, are subject to specific tax rules aimed at what? Eliminating the tax benefit of the deferral. Because the purpose you're doing this, the assumption is you are doing this to defer your taxes. Well, guess what? If it's a PFIC, there's no deferral anymore, whether the money is distributed to you or not. Now, there are three main methods by which earnings from these companies are taxed. One is called qualified electing fund method, mark-to-market method, and excess distribution method. We're going to go over each method and explain how it works, and hopefully it will kind of reinforce what we are trying to do. What is a qualifying electing fund method? Simply put, what we're saying here is I'm going to go ahead and pay my taxes. I'm going to declare it and pay it. Shareholders who choose this option must include the pro rata share of their earnings, both ordinary income and capital gain, and their taxable income each year, even if it's not distributed. You say, this is my earnings, whether that company, the PFIC company overseas, distributed or not. I'm just going to say I'm going to declare my income, declare my capital gain, and pay it. This method generally allows for capital gain treatment on the sale of the shares. You treat it as a capital gain. You avoid interest charges applicable to deferral income under the other method. So simply put, you just, you know what? Every year, I'm going to determine what's my share of capital gain, what's of my share of my income, declare it, and pay taxes. Now, in the year I actually receive it, I don't have to pay taxes because kind of, in a sense, I, in quote, prepaid my taxes. So that's one method. The other method is to do what's mark-to-market method. This method applies to those passive foreign investment company if their shares are publicly traded, meaning they are regularly traded and we know the price. Shareholders electing this method, mark-to-market, must include ordinary income each year, the increase in fair value of their shares with losses subject to certain limitations. Same thing, but what you do is you look at the market of your investment. If it's up, you include that in in your taxes. If it's down, you have losses, you offset. And this method aims to do what? Aims to tax the income on a current basis, eliminating the deferral advantage, because you don't want the deferral. What's going to happen when you have the deferral, the government's going to say you have to pay the taxes plus interest on that deferral. So let's assume you did not choose the first two methods, the QEF nor M2M, mark-to-market method. The default method comes into play upon the receipt of distribution or the sale of your shares. Under this method, the gains and the distribution are taxed at the highest tax rate. For each tax year in which the income was earned, so they say this is the highest tax rate for that year, you'll be taxed on that. In addition, you'll be charged interest added to your account for any deferral period. So this method can result in high taxes, high bill and interest charges. The reason is what? Is to discourage you from waiting, and they want you to report your income on a current basis, either using the QEF method or the mark-to-market. So this way, you keep paying taxes and you are current. Let's take a look at this multiple choice questions from farhatlectures.com. Which type of income is considered when determining if a foreign corporation is a passive foreign investment company under the income test? So what income do we look at? Do we look at active business income, U.S. source income, passive income such as dividend and interest, capital gain from the sale of U.S. real estate? Well, passive foreign investment income it deals with passive income. So it's not active business income, because that's active business income. It's not U.S. source, because if it's a U.S. source, we don't have to worry about this foreign corporation. Passive income as dividend and interest, yes, you would look at this. And if it's more than 75% is passive, then you are subject to that. Capital gains from the sale of U.S. real estate, not from the sale of U.S. real estate. No. The answer is C. C as in Charlie. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you prepare for the CPA exam, help you with your accounting courses. Invest in yourself. Good luck, study hard, and of course, stay safe.